This is the story of how the internet was almost destroyed by foosball tables, sock puppets, and wild stock speculation. From teenage day traders hitting it rich to Amazon dropping down to $6 a share, we are breaking down how the 2000 dot-com crash wiped out $5 trillion. And more importantly, how a few stubborn nerds in garages managed to rebuild the digital world. Let's dive straight into this explainer.
Now, here is a totally counterintuitive paradox for you. If that $5 trillion dot-com destruction never happened, the modern internet as we know it simply wouldn't exist. Crazy, right? The internet practically died before it even got out of its diapers. But that massive wreckage, it was entirely necessary. To understand why we actually needed a financial apocalypse to give us the digital world we live in today, we have to rewind the clock just a bit. Picture it, the mystical, deeply frustrating land of 1995. Logging onto the web was a whole event. As the saying went back then, it blinked, it buzzed, it screamed at you like a haunted fax machine. You'd sit there patiently waiting 5 whole minutes just for a single pixelated picture of a dancing baby to load on your dial-up connection. But honestly, nobody cared. Just being online made you feel like some sort of tech prophet. Everyone absolutely agreed that this glitchy, glowing box was the future.
So how did that innocent dial-up excitement mutate into what we now call the dot-com delusion? Well, it turned into this wild period of extreme speculation. Investors were literally pouring billions of dollars into any startup that ended in .com, completely ignoring whether the business was even viable. Wall Street started reacting to the words online bookstore like a dog hearing a chip bag open. They funded absolute madness because everybody was utterly convinced they were underwriting the next industrial revolution. And the sheer absurdity of this era was staggering. Just think about some of these. You had toiletseattracker.com snagging a $200 million valuation for using AI to predict when public restrooms would be vacant. Seriously. Then there was pets.com, famous for that sock puppet mascot, actively burning through investor cash by shipping 50-pound bags of dog food at a massive loss. You had eToys burning through money like a Bond villain hosting a backyard barbecue. Companies were running Super Bowl ads without even having a product yet, essentially begging the audience to please clap for their upcoming launch in March. If you had a terrible idea, a Microsoft Paint logo, and could say the word disruptive with a straight face, you could easily raise $100 million. What's fascinating here is how completely blinded the investors were. They were entirely focused on funding good vibes, catchy .com names, office nap pods, cereal bars, and Razor scooters. They literally celebrated burning cash because it supposedly meant you were scaling. But scaling to what exactly? Nobody really knew. Meanwhile, they completely ignored the actual business fundamentals that mattered. Little things like paying customers, measurable revenue, and actual profitability. They were essentially throwing billions at companies that operated more like daycares for aspiring billionaires. This delusion snowballed incredibly fast. The dial-up era kicks off in 1995, and in just a short window between 1998 and 2000, over 12,000 new dot-coms are born. Which brings us to the euphoric peak, March 10th, 2000. The NASDAQ hits a staggering all-time high of 5,048. Champagne is flowing, everyone's rich on paper. But then, almost imperceptibly, things started to crack. Those annoying questions that were once considered totally optional, like, hey, wait, what's your actual revenue, came roaring back, triggering a brutal 2-year collapse. The NASDAQ didn't just dip. It plunged, a catastrophic 78% drop, straight down to 1,114. Companies like Webvan, which had just spent over $1 billion building this hyper-optimized grocery delivery empire, suddenly had to report devastating losses. The mood in Silicon Valley shifted overnight from boundless confidence to outright sweating panic. The media, which had hyped it all up, quickly rebranded the entire revolution as the dot-con. The scale of the financial destruction is almost hard to wrap your head around. A staggering $5 trillion vanished from the global economy. That is a 5 followed by 12 zeros. Just gone. Over $1.7 trillion in market value completely evaporated, erasing more than half of all dot-com startups from existence overnight. The physical and cultural fallout was absolutely massive. Those stock options you thought were making you a millionaire? Worthless. Engineers were packing up their desks, and those expensive office foosball tables literally ended up in dumpsters. Failed CEOs quickly pivoted, rebranding themselves as cautionary tales to give TED Talks on losing everything. The narrative flipped so violently that having .com in your name made you financially radioactive. And arguably the saddest part, college students just quit coding. Computer science enrollments dropped by over 30% by 2005 because, to most people, the digital dream seemed completely dead. It was a landscape so incredibly bleak that we ended up with this beautifully surreal historical footnote. For a brief, bizarre moment, the most financially stable website in Silicon Valley was actually Neopets. Yeah, you heard that right. While Amazon was losing 95% of its market value, the only reliable online business out there seemed to be feeding virtual pixelated pets. But this is exactly where the story pivots. The flashy, cash-hemorrhaging giants like Webvan, Pets.com, and eToys, they all died leaning into wild gimmicks with zero sustainable demand. But look at the quiet survivors. Amazon, Google, eBay. They survived the crash by completely ignoring the hype, refusing to panic, and actually solving real problems while maintaining positive cash flow. Wall Street had basically marked Amazon for death. Everyone watched their stock freefall from $107 to just $6 a share. But Jeff Bezos didn't flinch. His mindset during the crash was brutally clear. We deliver books, not dreams, just books. He ruthlessly cut out the unprofitable gimmicks and focused entirely on the relentless execution of getting a paperback to a customer in Nebraska cheaper and faster using pure logistics. Meanwhile, you had founders like Sergey Brin and Larry Page at Google. They skipped all the flashy launch parties to quietly write code in a garage, refining the search algorithms that would go on to redefine the entire internet. They actually built AdWords initially just as a clever way to keep the lights on. And eBay? They just stuck to sustainably connecting real people who wanted to trade goods. These survivors proved a massive enduring lesson. You only get to scale after you prove there's real demand. Now here is the absolute biggest secret of this entire explainer. During that massive, chaotic boom, billions and billions of dollars had been poured into physical infrastructure, servers, huge data centers, and miles of underground fiber optic cables. When the hype died and the silly startups vanished, all of that state-of-the-art physical hardware just sat there. It remained. People called it the Roman roads of the internet. An entire, incredibly powerful digital skeleton was left behind, available for pennies on the dollar. So this spectacular crash actually built the modern world, and it happened in 3 distinct phases. First, the wreckage leaves behind all this massive abandoned infrastructure. Second, because of that cheap hardware, a new generation of scrappy platforms, think Facebook in a dorm room or YouTube in a garage, didn't have to spend billions building the roads. They just piggybacked on the cheap, leftover internet skeleton to launch their empires. And finally, the ultimate catalyst. In 2007, Steve Jobs reveals the iPhone. Suddenly, the internet stops being a place you visit at a desk and becomes a world you live inside. The phoenix had fully risen from the ashes. So as we look at the tech titans reshaping our world today, it begs a really fascinating question. What current tech obsessions are just passing fads? And who are the stubborn builders refusing to quit in the background? Because the truth is, the internet didn't die in 2000. It just rebooted. And it rebooted not because of flashy Super Bowl ads or launch parties, but because quiet engineers kept laying the physical foundations for our future. So, as we look ahead to whatever comes next, keep your eyes on the quiet ones.